Crisis will happen.
The biggest fiscal stimulus we have ever seen.
And that'll solve the problem. We're in the midst of a serious financial crisis, and the federal government is responding with decisive action. We boosted confidence in money market.
In this day and age, everything is connected to international capital markets, international trade flows, and migration. Many times, emerging markets are subject to the policies and decisions of advanced markets. So the question for emerging markets has become, should I just mimic the policies that are taking place in the industrial world, or should I do something different? Across the emerging world, concerns have risen about how well indebted companies will weather further turbulence. After years of powering the global economy, emerging markets are caught between fading growth and tighter lending conditions. So the global issue is the fact that rising debt in emerging markets poses a global threat.
I know many Americans have questions tonight. How did we reach this point in our economy? And what does this mean for your financial future? These are good questions, and they deserve clear answers.
Jay Tambay, emerging market corporate debt has gone from about $4 trillion in 2004 to over $15 trillion now, and we're seeing some defaults. But before we talk about the defaults, how did we get that big?
Several reasons. One is you had a flight from low-yielding economies because of our monetary policy, so people went looking for yield. You had a period of great expansion. You had a number of countries, China and the countries surrounding China, which really rode both the China boom and the commodities boom. These were attractive places to invest, and it was relatively easy for companies in that part of the world to raise debt without paying a lot in terms of interest rates. It was an attractive proposition for investors, and it was attractive for...
Now, economists at the World Bank have raised concerns that the slower growth seen in emerging markets since the tail end of the global financial crisis could be part of a longer-term trend. Now, Korea is no exception, with the economy widely expected to only grow in the 2% range next year. Hwang Jie has the details.
Growth in emerging markets has been on the decline since 2010. For 21 of the 23 countries included within this group, they have experienced slower growth in the last 3 years than before the 2008 financial crisis. The factors that have contributed to this differ between each country. For example, in Brazil, growth has diminished significantly because of commodity prices decreasing for major exports, while in Russia, they are suffering from energy prices falling as well as international sanctions that promote obstacles preventing growth. Another major factor that has caused emerging markets' current state is the external environment in other economies. Growth in advanced economies has been extremely low since the financial crisis. This, coupled with China's moderate growth, has caused global trade to be on the decline since 2011. And this has consequently interfered with economic activity in emerging markets.
In particular, in emerging market economies, you can see that a lot of the volatility in financial markets are driven by external factors, by capital flows coming from abroad. And so if we want to regulate just a domestic financial system and we don't address the capital flows, then we're missing out on an important part of where the instability is happening.
Capital inflows have been declining since 2011. And they have consistently been negative since the fourth quarter of 2014. This is the longest consecutive time since 2001 that net capital flows from emerging markets have been negative. This can be seen in all investment classes, but it is significantly more prominent in the foreign direct investments. Part of this decline can be attributed to the fact that the value of currencies in these markets experienced a decrease from 2011 to 2015. The majority of this occurred because of the U.S. dollar strengthening and speculations on future monetary policy decisions. Growth in emerging economies has been diminishing since 2010, while it has stabilized advanced economies since 2013. The diminishing difference between the two has made it less attractive to investors. The changes in oil prices further demonstrates the net capital outflows emerging markets are experiencing. This directly affects the financial stability of major exporters. At the start, it was primarily supply-driven, but in recent times, it has been more demand-driven. Expectations regarding United States monetary policy have a significant effect on developments in emerging markets. Primarily, this can be seen in the way emerging markets predict future cash flows. Differentials in economic growth between advanced and emerging markets is the key driver for net capital inflows for emerging markets. Taking these factors into consideration, it even further emphasizes the need for a Partnership for Growth initiative to ensure the sustainability of both emerging and advanced economies.
Emerging developing countries are home to 85% of the global population. That is about 6 billion people. And these 85% matter to the global economy more than ever. And they matter to you more than ever. The emerging and developing countries are now facing a much different reality, much harsher reality. Growth rates are down, capital flows have reversed, and medium-term prospects have deteriorated sharply. We at the IMF call for a new partnership for growth between the advanced economies and the emerging and developing economies in order to promote faster and more sustainable convergence between these economies.
The idea for Partnership for Growth means that both emerging and advanced economies will play their part to promote faster and more sustainable convergence. The idea is that strong policy actions by emerging and advanced economies can be a win-win for both. Advanced economies need to continue to support demand through accommodative monetary policies, but they should use a more balanced policy mix. The policy mix should aim at maximizing growth and minimizing unemployment. The world's financial leaders call for a forceful and balanced policy mix, a 5-factor approach of structural reforms, together with fiscal and monetary policy, to lift slowing global growth.
But in the meantime, our former Finance Minister, Trevor Manuel, who is of course the head of that planning commission, was part of a Commission on Growth and Development, which began its work in 2006, reported in 2008, and it identified what are the factors that make for rapid growth, for GDP growth in excess of 7% a year for 25 years or longer. 13 nations had achieved this, and they followed a formula for success with 5 factors. And those factors are, first of all, fully exploiting the global economy. Secondly, maintaining macroeconomic balance, generating high levels of saving and investment, allowing markets to allocate resources, and the 5th, perhaps the most important, having a committed and capable government committed to growth as its priority.
On the flip side, emerging markets could make their fiscal adjustment less painful by upgrading the efficiency of spending, strengthening fiscal institutions, and increasing non-commodity revenues. At the same time, allowing for greater exchange rate flexibility can help many of them soften the impact of the adverse external shocks they are facing. In many cases, emerging economies will also need to step up the use of so-called macroprudential tools to limit financial sector risk, either by monitoring the foreign currency debt that some of their major companies are carrying, or by limiting the fallout from the large credit expansion that many countries have gone through in recent years.
Now, in addition to safer capital flows, a stronger international monetary system must include an adequate global financial safety net to enable access to financial resources in times of crisis or distress.
The idea is that it takes 2 to grow. Both emerging and advanced economies need to address the underlying economic issues that are fundamental to boost potential growth and promote the sustainable income convergence that we talked about earlier. The first priority would be to foster more and better innovation by removing barriers, cutting red tape, enhancing the mobility of labor, and investing more in education and research. This would unleash entrepreneurial energy and help attract private investment in ideas that are new, surprising, and useful. The second priority would be to facilitate a greater sharing of technology between the advanced economies and their emerging peers. This would, for example, require finding a better balance between intellectual property protection and technology dissemination.
The advancement of technology happens faster than advances in most other segments, whether it's social or economic or other elements of social life. And so I see one of the frontiers, one of the areas that the industry is going to continue to approach is serving and connecting all segments of the population, even populations in the countries that are farthest down on the income scale.
The commonality I see between mature markets and emerging markets is that the experiences people want to have are very similar. The aspirations are very similar. What changes is the timing. It starts first in the most advanced mature markets, then it goes to the maturing markets, and then it goes to the emerging markets. But the time that is needed now to go from the most advanced countries to the most emerging countries has just shortened. When in the past we will need years, now it's maybe a year or two at the longest, and it's getting into months. So I think we're going to see the gap between the most advanced countries and the most developing countries to really narrow. And with with the availability of better technologies, better devices, more affordable technologies and devices, I think this is going to be growing even faster, and the gap in time is going to narrow even faster.
Another way to facilitate the sharing of technology and know-how is foreign direct investment. FDI into emerging and developing economies as a share of GDP is now well below what it was in 2000 and 2006. Our global forecasts predict it will fall even further by the end of the decade. So we need greater efforts to remove unnecessary barriers to FDI and to replace hot money with long-term investment.
I hope I have described for you what I regard as a new economic reality, and one that requires that new partnership between the emerging market economies, the developing economies, and the advanced economies. Because ones will not succeed without the others. And it is more so the case now because of these interlinkages and the space that each of those has now taken in the global economy. New reality, new partnership, and a new multilateralism as well that actually acts for the benefit of all and which is better equipped and more strongly and durably financed in order to respond to the risks and uncertainties that will continue to be, because that's part of the economic game in the world that we live in.
As President John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. Our message today is that the role of emerging and developing economies is a defining feature of the 21st century. We can create a more prosperous and more peaceful future for everybody.